Hey guys, welcome back to Sense or Sense. My name's Evan. I want to do something a little different today. You can see I've got my glasses on today. I want to go through a Wall Street Journal article that I found very interesting that has been an ongoing thing that the Wall Street Journal has done for a long time. And they talk about the randomness of basically picking random stocks versus fund managers going out there and researching stocks, and how it's been interesting many times over that it's equivalent to basically just throwing a dart at a dartboard and saying, okay, that number equates to a stock for random picking. And oftentimes the randomness wins. And that's my point today, is that I think that there's a good point to be made about the fact that individual picking of stocks is not the way to go. I've been an advisor for 17 plus years. I've been a trader for over 20 years. And I can tell you that for the long term, the best way to make money is through diversified ETFs, diversified mutual funds, owning some stocks that you care about a lot and just holding on to them for long periods of time. Having fund managers do picking of stocks, paying for financial advisors to pick stocks just does not make sense anymore. And let's go ahead and dive right into this article. So let's pull it up here. The title is "The Random Path to Stock Market Riches: How we made 80% in a year without really trying," by Spencer Jacob. It was published May 13th, 2024. And what he says is, "Words rarely heard from star managers. I just got lucky. Some insight, blame poor things, or unforeseen event for a lousy year, but success is somehow never an accident. It most certainly was for Heard on the Streets columnists as we once again trounced the best and the brightest in the hedge fund world. There are lessons here that could boost anyone's stock portfolio. Repeating an exercise from 2018, Heard's columnists took a cue from Burton Malkiel, author of the investing classic A Random Walk Down Wall Street, and threw 12 darts at stock market listings a year ago. We competed against the fund managers presenting their best ideas at last May's Sohn Investment Conference in New York City. Both the stocks and the type of bet, long or short, were beyond our control. Once again, the pros got schooled by randomness. The first time around, they lagged behind the dart tosses by 22 percentage points in 2018. This time, it was 48 percentage points, though the way that that was accomplished certainly isn't for the faint of heart." So let's stop here for a second and talk about this. Basically, this is a controlled setup where they had fund managers who gave them picks at a conference last year in 2023, and the Wall Street Journal just said, hey, we're going to randomly pick 12 stocks out there, and we're going to compete head to head and see which ones do better. And I've always found this really interesting. I've actually read the Burton Malkiel's Random Walk Down Wall Street. It's an excellent book if you have any interest in learning more about Wall Street and how it's functioned over the years. It was written many years ago, so it is, some of the concepts are going to be very antiquated, but a lot of it's very good. And it will teach you some things about trading versus investing versus randomness versus stock picking and whatnot. So it's a very good book. What I'll say about this is interesting. It goes on to say that some of the companies such as Maui Land and Pineapple behind our 80% returns were totally new to us, but we knew right away that the others were on shaky ground. One software company, Semantics, was later delisted and plunged by more than 97%. Another, NGL Energy Partners, survived and climbed by 117%. A third, Western Alliance Bancorp, was beaten down by last year's regional bank jitters, yet enjoyed a huge recovery. Unfortunately, it was one of our two short bets and cost our portfolio dearly. The biggest takeaway from our picks is this: while there are a few other winners, a single stock insurer, Root Incorporated, was responsible for all of our net gains. That hews to reality. A long-term study of U.S. stock returns by Hendrik Bessembinder shows that half of all excess returns came from just 83 companies. Most stocks underperform risk-free investments, which is why diversified portfolios not designed to shoot the lights out are more prudent. This is really important to understand. This is something I've preached in my practice for many years. You got to have a diversified portfolio. I don't care what anybody tells you. You can use ETFs, you can use mutual funds, you can use individual stocks. You can combine all three together, which is the best method. But if you don't want to be a stock picker, I understand that. Some people don't have the time. Some people don't have the ability to do so, and there's nothing wrong with that. You can get diversified ETFs for low cost, and that will be sufficient enough for you to be a good long-term investor. And so the results of this, the percentage of U.S. companies responsible for wealth creations from 1929 to 2019, it said that 50% of all wealth creation was generated by just 2.03% of all stocks in the stock market. That is pretty amazing statistic. 2% of all the stocks out there made people more than 50% of their returns in the stock market. That tells you that you cannot be a stock picker in the long term and ultimately make a ton of money. It is much better to be diversified. Okay, let's go on. Percentage of U.S. stock funds failing to beat their benchmark over a certain period of time. 1 year, 60% failed to. Over 5 years, 80%. Over 10 years, over 90%. In 15 years, 87.98%. So this tells you that, ultimately you got to get out there, you got to diversify, you got to do some management every once in a while, but you don't want to really spend a lot of time on doing a lot of these things. Let's continue on with the article. The Sohn panelist picks all sounded like a good idea at the time, and many were for a 1 year period tracked. David Rosen of Rubric Capitals pitched to Talon Energy, a nuclear power provider that was emerging from bankruptcy, and rode a wave of enthusiasm for the power source, returning almost 129%. In second place was Andrew Weiss of Weiss Asset Management, who picked a trio of Korean companies. The best was SK Square with a total return of 81%. By contrast, Divya Natimini's pick, Japanese electronics and entertainment giant Sony, declined 15%. Herd's columnists won't be going into the fund management business because we can't claim that it was all in the wrist, so to speak. A few blowout years have been plenty, though, for mutual fund aces, including Kathy Wood or Bill Miller, who later stumbled. Fund management's dirty secret is that investors' actual dollar returns are even worse than active funds' stated returns, which on average trail behind simple index funds. Okay, so this is exactly what I've been saying in my last couple of videos. Index funds are the way to go. ETFs, index mutual funds, actively managed funds do not make sense, and they just end up underperforming for the most part in the long term. So, this is an important point to be made about investing in general. Keeping your expenses low, diversifying, starting early. These are all things that I've said over and over again. Taking advantage of tax advantaged accounts like Roth IRAs, 401ks, getting free matches from your employer. These are all the things that are going to make you very wealthy in the long term. It's not about individual stocks, picking the next Apple, although that would help. The problem is there's about 80% of all the stocks out there that are never going to make you anything or lose you money, and only 10 to 20% or less that are ever going to make you money. And as we've said earlier, only about 2% account for 50% of the returns in the market. This is a really important point. Continuing on and finishing the article, it says dart throws, if done right, really can beat the market in the long run. According to a study by Towers Watson and research affiliates, the surprising alpha from Malkiel's monkeys, the likely explanation is how they were weighted, since regularly rebalanced portfolios of small stocks have been beaten large indexes over time. Recreating random picks on your own takes extraordinary discipline, though. Would you stick with a company known to be in trouble? Luckily, that isn't necessary. With only a small bump in measures of volatility such as standard deviation, equal-weighted index funds, as opposed to more common variety, give greater exposure to risky outliers. An equal-weighted index of U.S. stocks maintained by MSCI has modestly beaten the equivalent capitalization-weighted index over nearly 30 years and might be due for even more as it becomes cheap in the eyes of the Magnificent Seven era. At the end of April, the equal-weighted index had a price-to-earnings ratio of 14% lower than the capitalization-weighted version. But even a vanilla index fund that costs very little contains those needles in a haystack. Trusting fund managers to find and then keep owning them might result in frustration. S&P, Dow Jones, and indices shows that outperforming mutual funds in one period have very poor odds of following up. In 2020, for example, only 43% of US stock mutual funds beat their index. Of that group, only 2.5% kept it going for the next 2 years. Luck has a way of running out. There you go. That's what I'm going to say. Active fund management, paying for advisors, paying for fund managers, paying for hedge fund managers is not the way to go, guys. I'm going to leave it at that today. This has been really interesting for me. It's a good reminder even for people that are in the industry. My name's Evan. This is Sense or Sense. I would appreciate you guys subscribing and liking the channel, smashing the like button. Thanks for tuning in. See you next time.